Hi, I'm Imogen and I'm joined here today by Josh Holbrook, Associate Director in the ESG Strategy Group at KPMG, specialising in financial services. So Josh, why is it important for the financial services industry to embed climate considerations into decision-making and operating models?
Right, so that's a big question, Imogen, but I think the first and foremost answer I'd like to give is the right thing to do for our planet. Many say that we're in a bit of a climate crisis. We're seeing transition and physical risks manifesting themselves, and financial institutions have in control trillions of dollars and pounds of assets. So by putting that capital into the right place, we can live in a world where we're financing the right outcomes. So whether that be financing companies that are having a positive impact on our climate, or supporting those that are transitioning from the operations they're currently doing, and also discouraging the bad behaviour that could lead to detrimental impacts for our planet. The second point is in terms of financial system resilience. So a lot of what the regulations are looking at the moment is how resilient different sectors, countries, companies are to different climate scenarios. So by getting across and understanding where those risks and opportunities may be, can build ultimately a safer financial ecosystem for the world going forward. The third part, and one of the ones that's most interesting for a lot of clients, is that it creates value and can preserve value as well. So I think understanding where risks and opportunities are, starting to quantify those and acting on them is just good business, both for shareholders, but also for insurance companies, for example, policyholders as well. There's then a big regulatory component. So a huge number of climate regulations have come into effect and are continuing to come into effect. So there's a bit of a compliance angle there that you have to get up to speed with this stuff these days.
And so what are the current best practices for integrating climate risk assessments into financial services, and how can organisations implement these most effectively?
It's another great question. So I suppose just taking that in turn, a climate risk assessment is considering what are the various transition risks, so the transition to a lower carbon economy, how they may have an impact on your business, and what the physical risks could be. So the manifestation of acute and chronic risks. So what we do when we're supporting clients here is to identify what these risks and opportunities are, like there's always an upside to this, and starting to think more robustly about when they could hit, different scenarios, different timeframes, and what the magnitude of that impact could be. So within the financial institutions world, this can have a different impact depending on the type of business that you are. So if you're a bank and you're providing mortgages, it might be considering what are the physical risk elements that could manifest that would impact house prices on those you provided a mortgage for. In the insurance space, it could be how might these changes impact the cost of the claims that I have to service, and what would I need to change my premiums to make myself, keep making money. And then in the asset management space, firms are considering in these different scenarios and over different timeframes, what's the potential impact to the value of my investment? How might these companies' earnings change over time? But I think what's important to note is that all clients and many companies are on a journey in this space. So whilst we are working with some that are aspiring to the best practice, and that could be detailed, quantified scenario analysis, there are many options that are available. So really it's picking one that is most suitable for you as a business at this point, and then thinking about how you might want to develop that going forwards. So yeah, not like a concrete answer on what's exactly best practice, because it varies for what's best for you. But yeah, lots of things that many firms are looking into at the moment.
Yeah, that's a great answer. And then leading on from that then, how can KPMG support our clients in the financial services industry in embedding climate into decision making?
Well, I think, and just building on my last answer, this is, it's broader than just climate risk. So it's broader than understanding what those risks could be and quantifying them. It's also considering things like decarbonisation strategies, building broader transition plans, which is one of the bits of work that the UK government is leading with the Transition Plan Task Force, and kind of everything in between. So it could be embedding ESG into investment decisions or ESG DD, all the way through to operations and governance, technology, and then on the reporting side, things like carbon accounting and financed emissions. So the topics are really very, very broad. These are increasingly, whilst there is this strategic rationale for why these are so important to do, there is a regulatory component as well. So we've got ISSB, the international standards sort of coming down the track, CSRD with the EU, which is causing a lot of companies to really think about things now, and they're also bringing out the CSDDD in not too long. It's the acronym soup that's coming through. So there's that huge regulatory component. So what we are looking to do with clients is to break down the complexities of all the requirements that firms have to do, want to do, should do, to make it manageable for your business, for our clients' businesses, in a way that's truly valuable.
Thanks, Josh, for sharing your insights with us today. We look forward to seeing you in our next episode.